Intrinsic value. What is it? How can you perform an intrinsic value calculation? And how can you use this mythical intrinsic value to make better investment decisions? This is what we're going to talk about on today's episode of Nordic Finans. But before we do that, greetings my fellow investors, my name is Lucas, and please, if you enjoyed today's episode, take a quick second to invest in the subscribe button and deposit a like on the video.
NANI?!
Nice.
Now, there are several ways to calculate the intrinsic value, and there is no real golden standard to follow. However, it is extremely important to realize that you always make at least some assumptions and guesses when it comes to calculating the intrinsic value of a stock. Today we will focus on how you can calculate the intrinsic value as simply as possible. This means that we're going to be less precise than some of the more detailed models, but since all models still make the same fundamental assumptions, it is more important for us to properly understand and scrutinize these factors and the impact that they have on the accuracy of our final intrinsic value, instead of just worrying about the precision and worrying that we get every single sort of detail right. In other words, when it comes to investing, it is much more important to be roughly right than precisely wrong. With that said, let us hear what the big man himself has to say about it. So, Warren Buffett, what is the intrinsic value?
Well, intrinsic value is the number that if you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
Now on the screen you can see the basic formula of what Warren just said. This is the intrinsic value as defined by the discounted cash flow evaluation method. And now half of you have probably jumped off the chair in wild desperation while looking at this, but in reality, just like Warren said, we only really need to find out two things. 1. What is the future cash flow of the business from now until kingdom come, i.e. how much money will this business produce for us over its remaining lifetime? This is going to be the harder part to find out. 2. What is that future money worth to us today? So, putting a bit of time travel spin on it, future money, what is it worth to us today? That's also going to take some figuring out to do, but it's going to be a lot easier. So, to dive into point number 1, how do we find out how much money a business generates for its earners in the first place? To do this, we can calculate what is called the owner's earnings. We can do this by diving into the financial statement of a company. Then we'll find the operating cash flow and subtract this by the maintenance capital expenditure. However, maintenance capital expenditure can sometimes be quite difficult to find, so instead of calculating owner's earnings, one can simply use the free cash flow, which can also be calculated by again taking the operating cash flow and subtracting the total capital expenditure. While this is going to be less precise, it does land us on the right side of safety, meaning it's going to be more conservative in our guesstimation, which is of course always nice and what we want. Remember, roughly right instead of precisely wrong. To be on the safe side, we should probably also compare the free cash flow of this year to the one of the 2 previous years as well. This is because it might be possible that the company has had an extremely good or bad year one particular year. If so, this should become apparent when we look at a few of the past year's performances. Now, if you are a beginner like myself, the best way to get started with all of this and finding the free cash flow as quickly as possible might often be to just Google it. I'll be totally honest with you. You'll find a pretty good estimate or pretty good calculation there if you just Google it. Personally, I like to use macro trends But if you have another site that shows the same information, please let me know in the comments. After this, we should estimate how much this company will manage to grow their future cash flow. Now, this is where the real guesswork is going to start, and this is going to be the most important thing to get as accurate as possible, and again, to err on the safe side instead of the not so safe side, because it's going to shift the value hugely. To calculate the current growth rate, you can subtract last year's earnings per share, or EPS, from this year's EPS and divide that number by last year's EPS. See the formula on the screen, that should help you. What I suggest you do is also to take the average of the 3 or more latest annual growth rates that you calculate in the same way. So if you want it for 2017, you take the earnings share for 2016 divided by 2017, same way as you did. And then you're going to take the average of these 3 latest annual growth rates. It will probably also be a good idea to compare this with the 10-year average growth and 3-year average growth as well, if you can find that data. Alternatively, you can find the expected future growth rate on bigger companies from professional analysts, for example on Yahoo Finance. I'll show you that now. This can be done online, as I said, by finding your company of interest, for example, on Yahoo Finance, filling in the company of interest ticker symbol or name, and navigating to the analysis tab. And at the end of it all, the more time you spend on this part and try to improve your guess of the future growth rate of the company as much as you possibly can, the better you will be off, since this is one of the most important variables to get accurately, because it's really going to start compounding. Like any errors you get here is going to compound for each year that passes, as you will see soon. And as always, if you're uncertain, use a safer growth rate, meaning like a lower growth rate that you find. Then at least you won't make like a bad purchasing decision. It's better to buy less than to buy many things that's like just a little bit too expensive, I would say. Then finally, you need to start estimating how much the future cash flow will amount to. This can be done by multiplying the current cash flow with the growth percentage plus 1 to the power of the number of years it's had to grow, just like what you see on the screen. So if we would use Apple as an example, the free cash flow would be 73.36 billion in 2020. If we look at the trend, this seems a bit on the high side, I would say. And remember, we can use an average. So let's do that for our example. So the average cash flow for Apple for the last 3 years is going to be these 3 numbers summed up and then divided by 3, of course. Hopefully you know how averages work. And this is going to amount to 65.46 billion. So let us go ahead and use that number. Then the estimated growth rate for Apple, as defined by other analysts, is 17.93% annually for the next 5 years and 8.42% after that, as you can see here on Yahoo Finance. Personally, that seems quite much, but again, who am I? I've been doing this for like less than a year or almost a year now, so I can't really argue with the professionals. Then again, I would strongly recommend that if something seems out of line to you, dive further into it. Like, it costs you nothing. Try to figure out if this could be based on like previous data, based on what they are planning to do. Try to find out more information, and this will probably help you to get a feeling of if this is at all reasonable or not. But for now, we'll use this as an example. So we'll use the 17.93% for the first 5 years, and after that 8.42%. So to calculate then the growth or the increase in free cash flow for each year, we're going to start with this year, or the cash flow for 2021, which is going to be 65.46 billion, the average that we calculated earlier, times 1.1793. So that's just to make it increase by the growth percentage. That's what that number is. And then take that to the power of 1 to adjust it for compounding. So since this is the first year, it hasn't had the time to compound yet, so it's just one. The following year it's going to be 65.46 billion times 1.1793 to the power of 2 for the second year, and so on and so forth. Now, alternatively, what you can do is put it up in an Excel. That just means that you're gonna have the starting out free cash flow, in our case 65.46 billion, and then between each column you're gonna add, or you're gonna take that times 1.1793, and that's gonna do it for you. Now at this point, if you're feeling like this, don't you worry about it. There are already several free Excel spreadsheets out there that you can find that do this automatically for you. But now at least you better understand what each component is and how you can evaluate it. And then finally, you also have to add any excess capital plus a so-called terminal value, which is just a multiple, usually between 10 and 15 of the free cash flow. So in our case, this is going to be 65.46 billion times 10 to 15. Use a lower multiple for a lower quality business and a higher for a higher quality business. Now, moving on to part 2, figuring out what this future money is worth to us today. And at this point you might say, Lucas, what do you mean? Isn't the future money and today's money basically worth the same? I mean, $1 million is always going to be
$1 million.
Well, not quite, my young Padawan. Because what about inflation? What about the fact that I can throw the money into an index fund and earn around 8%, relatively risk-free? Check our video on index funds if you want to know more about those. For these reasons and more, we need to discount all future cash flow at an appropriate rate. If you are new to this, I would recommend using just a flat discount rate between, let's say, 8 and 15%, somewhere along those lines. The higher you put the discount rate, the safer you're going to be off in not buying anything too expensive, but it's also going to be harder to find good deals. So keep that in mind. Now, you're going to need to discount the cash flow from each future year by this appropriate amount. And remember that just like when the company grows, this discount rate also compounds. If we now take another look at the formula I showed you at the beginning of the video, things should start making a little bit more sense, at least now. So here you can see the formula again. So the numerator is gonna be the future cash flow for each year, and then the denominator is going to be 1 plus the discount rate to the power of which year in the future we collect the money. So for our case, let's say that we plug in a discount rate of 10%, so 0.1. Then we still have to take that plus 1 just to get it to work properly, otherwise it's going to increase the amount instead of decreasing it. So we're going to take it for the first year divided by 1.1 to the power of 1 for the first year. Then for the second year, we're going to take the future cash flow for the second year and divide it by 1.1 to the power of 2, and so on and so forth. So now finally, when we've added all of these total future cash flows together, as well as discounted them properly, you will get a total value. And this total value you can compare to the total market cap of the particular stock of interest, because the total market capitalization simply refers to the total dollar market value of a company's outstanding shares of a stock. This is then commonly referred to as the total market cap, and it is calculated by multiplying the total number of a company's outstanding shares, meaning the shares available simply, by the current market price of one of these shares, getting the total worth. So how can you use this intrinsic value which we just calculated to better inform your investment decision? Well, in a nutshell, you have just more or less successfully, hopefully, calculated what the true, or in other words, fair evaluation of the stock is. And therefore, you can now compare that to what it's currently worth, meaning comparing it to the total market cap. But, and I cannot stress this enough, at this point, it's gonna be super important, especially as a beginner, to realize that you've probably done something wrong, made estimations wrong, things might not turn out, so therefore you should still, no matter how conservative you've been in your calculation so far, add a proper margin of safety. And what is a margin of safety, you may ask? Well, this is gonna act as an extra layer of protection against different risks. So, your assumptions, as I said, may be wrong. Your estimations may be too optimistic, even though you don't think so. Because in fact, the majority of people tend to be much too optimistic when they try to predict anything about the future. If so, it's gonna follow that you might have calculated the intrinsic value of the stock that you are now interested in as too high. And regardless, even if all of your estimations and calculations are correct, something totally unforeseen might still happen in the next 5 to 10 years, who knows? So to apply your margin of safety, thankfully, is quite simple. You simply cut the intrinsic evaluation, which you've just calculated, in two. So this means that you have added a margin of safety of 50%. 50% might sound like a lot, but especially as a beginner, you should not try to cheat yourself out of this part, because it's just gonna bite you in the end. So just do it and look longer and invest more seldom. And when you find something truly great, then you can put a bit more into it. And remember, you can always just put your money into index funds to be on the more of the safe side, because then at least, even though your investments might go down from time to time, they won't disappear completely. So if you want to learn how to do that, I'll link a video here for you, so watch that after this one. Because as I've already hinted to, what you're gonna find in this 2021 market right now, it's still very, very hot. And finding companies which are evaluated or priced currently well below their intrinsic value, that's just gonna be extremely difficult. If you struggle with finding good prospects, I really recommend that you watch the beginning of this same playlist. I'll link it here in case you haven't watched it from the beginning yet. This playlist is designed for you when you first get started with investing into individual stocks. How do you find them? How do you sort out bad ones from good ones? How do you find a truly great prospect? And then finally, how do you evaluate to check what's a fair price to pay for it? So hopefully by watching that, it's going to help you to quickly find more good prospects, and then also sort out companies that are just traps. So I'll link that all here and put that as the next thing to watch, along with a video that YouTube recommends as the one that's best suited for you. So with that said, have a great day everyone, and as always, happy investing.
$100 billion.
Nice.